Have you ever stopped to wonder why the interest rate on your car loan suddenly seems a bit higher, or why the cost of a gallon of milk has crept up over the past year? The answer, more often than not, leads back to a powerful yet often misunderstood institution, the Federal Reserve. In the simplest terms, the Federal Reserve, or the Fed as it is commonly known, is the central bank of the United States. Its primary mission is to steer the country's vast and complex economy, aiming to keep it stable and healthy. It operates as a kind of economic ship captain, tasked with navigating the choppy waters of inflation unemployment. The creation of the Federal Reserve was not a sudden decision, but a response to a series of financial panics that plagued the nation in the late 19th and early 20th centuries. Before 1913, the United States lacked a central authority to manage the money supply or provide emergency support to struggling banks. This absence often led to bank runs, where fearful depositors would rush to withdraw their money, causing otherwise solvent institutions to collapse. The Panic of 1907 was the final straw, a severe crisis that convinced Congress of the urgent need for a more resilient and flexible financial system, leading to the passage of the Federal Reserve Act in 1913. The Fed's importance in our modern world cannot be overstated. Its decisions ripple through every corner of the economy, influencing everything from the job market to the stock market. The Federal Reserve's purpose is guided by a dual mandate assigned to it by Congress: achieving maximum employment and ensuring price stability. These two goals are the North Stars that direct all of the Fed's actions. Maximum employment does not mean a 0% unemployment rate, which is unrealistic, but rather the highest level of employment the economy can sustain without triggering runaway inflation. It means creating an environment where businesses are confident enough to hire and expand, and where individuals seeking work have a strong chance of finding it. This objective is about fostering widespread prosperity and economic opportunity for the American people. On the other side of the coin is price stability. This means keeping inflation, the rate at which the general level of prices for goods and services is rising, low, stable, and predictable. When inflation is high and volatile, it erodes the purchasing power of your money, making it harder for families to afford basic necessities like food and housing. It also creates uncertainty for businesses, making it difficult for them to plan for the future. The Fed generally aims for an average inflation rate of around 2% over time, a level considered low enough to not distort economic decisions, but high enough to avoid the dangers of deflation, which is a period of falling prices. These two mandates can often seem to be in direct conflict with one another. For example, when the economy is weak and unemployment is high, the Fed might lower interest rates to encourage borrowing and spending, which helps stimulate job growth. However, this same policy can sometimes lead to an overheating economy where demand outstrips supply, causing prices to rise too quickly. Conversely, when inflation becomes a problem, the Fed may raise interest rates to cool down the economy, but this can slow business investment and hiring. This inherent tension requires a constant and careful balancing act. The Fed's leaders, therefore, spend their days poring over a vast array of economic indicators, employment reports, retail sales figures, consumer confidence surveys, global market trends. They are constantly trying to gauge the health of the economy and determine whether it needs a gentle nudge in one direction or the other. Their decisions are not made lightly. They involve complex forecasting and a deep understanding of how different policy tools will affect households and businesses across the country. It is a monumental task of economic stewardship, attempting to keep the ship steady through both calm seas and turbulent storms. To accomplish its dual mandate, the Federal Reserve wields three primary tools. The most well-known is its ability to influence interest rates, specifically the federal funds rate. This is the interest rate that banks charge each other for overnight loans to meet their reserve requirements. While you and I don't pay this rate directly, the Fed's target for it sets the tone for the entire financial system. When the Fed lowers this target rate, borrowing becomes cheaper for banks. Those savings are typically passed on to consumers and businesses, lower rates on mortgages, lower rates on car loans, and lower rates on business loans. That encourages spending and investment. The second major tool is open market operations. It involves trading government securities like treasury bonds on the open market. When the Fed wants to stimulate the economy, it buys securities from banks, increasing funds available for lending. Conversely, to combat inflation, the Fed sells securities, pulling money out of the system. Think of it like a reservoir. Buying bonds adds water, selling bonds drains water. The third tool is the reserve requirement. It's the minimum percentage of deposits banks must hold as reserves. Those reserves ensure banks can meet sudden withdrawal demands. Lowering the reserve requirement lets banks lend a larger share of deposits, which can stimulate activity. Raising it restricts lending, which can slow the economy. Because the effects are powerful, changes to reserve requirements are rare. Imagine you're planning to buy a house. If the Fed recently lowered interest rates, your bank will likely offer a mortgage with a lower rate. That can make your monthly payment more affordable, encouraging you to buy. Multiply that decision across thousands of buyers, and you invigorate the housing market and related industries. This shows how the Fed's policy choices in Washington translate into real financial consequences for everyday people, shaping major life decisions and the overall pace of the economy. The connection between the Federal Reserve's policies and your daily life might seem distant, but its influence is pervasive. Consider the prices you pay at the grocery store. When the Fed works to keep inflation low and stable, it helps protect the value of your dollar. If inflation were allowed to run rampant, the cost of everything from bread to gasoline would soar. Bread gasoline. By raising interest rates to cool an overheating economy, the Fed makes borrowing more expensive, which tempers overall demand and helps keep price increases in check, acting as a crucial brake against a runaway cost of living. Now, think about the job market. The Fed's actions have a profound impact on employment opportunities. When the economy is in a downturn and people are losing their jobs, the Fed typically lowers interest rates. This makes it cheaper for businesses to borrow money to invest in new projects, build new factories, hire more workers. A small business owner who was hesitant to expand might see lower loan rates as the green light to finally hire that extra employee they need. In this way, the Fed's pursuit of maximum employment helps create a healthier and more robust labor market for everyone. The cost of borrowing money is perhaps the most direct way the Fed's decisions touch your finances. When you apply for a loan, whether it's a mortgage to buy a home, a loan for a new car, or even the interest rate on your credit card balance, the rate you are offered is heavily influenced by the Fed's policy stance. Mortgage to buy a home loan for a new car credit card interest rate. When the Fed raises its target rate, lenders across the board increase their own rates, making all forms of credit more expensive. This can directly affect your budget and your ability to make large purchases, illustrating a clear and immediate link between the Fed's boardroom and your kitchen table. Even your savings are not immune to the Fed's influence. When the Fed keeps interest rates low, the return you earn on your savings account or certificates of deposit will also be quite low. While this is frustrating for savers, it is part of the policy designed to encourage spending and investment rather than hoarding cash. On the other hand, when the Fed raises rates to fight inflation, savers are rewarded with higher yields on their deposits. This dynamic shows how the Fed's policies create different incentives for different economic behaviors, affecting whether it is more attractive to save, spend, or invest at any given time. Save, spend, invest. Essentially, the Fed functions as the banker's bank. Just as you or I might go to a local bank for a loan or to deposit our savings, commercial banks turn to the Federal Reserve for similar services. It provides liquidity to the financial system, ensuring that banks have the funds they need to operate smoothly day to day. It also supervises and regulates these banks to protect consumers and ensure the entire system remains sound and secure. In summary, the Federal Reserve acts as the nation's primary economic steward, tasked with a delicate and continuous balancing act. Its fundamental purpose is to foster a healthy economy by pursuing two main objectives: keeping employment high, keeping prices stable. It is the institution working behind the scenes to prevent the kind of boom and bust cycles that can cause widespread hardship. By understanding its role, you can better understand the forces that shape your own financial world, the cost of goods on store shelves, the availability of jobs in your community. To achieve these goals, the Fed utilizes three powerful tools. First, it adjusts the federal funds rate, which influences all other interest rates and determines how expensive it is to borrow money. Second, it uses open market operations, buying and selling government bonds, to increase or decrease the overall money supply in the economy. Together, these levers allow the Fed to either stimulate a sluggish economy or apply the brakes to an overheating one, always aiming for that sweet spot of stable, sustainable growth. The ripple effects of the Fed's decisions are felt on every main street in America. A change in interest rates can determine whether a family can afford their dream home, whether a small business can expand and create new jobs, or how much interest you earn on your hard-earned savings. During times of crisis, like the 2008 financial meltdown, the Fed can also step in as a lender of last resort, providing critical stability to prevent a total collapse of the financial system. Its actions, while complex, have direct and tangible consequences for the financial well-being of all Americans. While you cannot control the Fed's decisions, you can become a more informed economic participant. A simple, practical step is to pay attention to news about the Fed's interest rate policies. When you hear that the Fed is planning to raise or lower rates, think about what that might mean for your own financial plans. Is it a good time to refinance your mortgage? A great first action is to simply contact your bank or look on its website to check the current rates for savings accounts and loans. This small act of awareness empowers you to navigate the economic currents, rather than simply being carried along by them.